Many affluent families assume their biggest financial risk is market volatility. But in practice, the real pressure often comes from something quieter: tax drag, concentrated exposure, and poor coordination between investments, income planning, and liquidity strategy. Two families can have the same net worth, yet one pays dramatically more in taxes each year simply because their structure was never intentionally designed. The issue isn't what the portfolio earns, it's what the family actually keeps. If taxes have become a permanent participant in your returns, this conversation is for you. Welcome back to Investing Outside the Box. I'm David Harris with Alternative Investment Advisors. I work with business owners after liquidity events, senior executives with concentrated positions, and families navigating RMDs, Social Security stacking, and high passive income friction. Today, we're going to rethink taxes, not as a fixed outcome, but as a design variable that can often be reduced, deferred, or better coordinated across the portfolio. Disciplined savers often assume that consistent saving naturally leads to tax efficiency. But for high net worth families, the opposite can happen. I recently reviewed a case where decades of saving created a future tax spike. As their RMDs, Social Security, and portfolio income converged, their taxable income was projected to rise, not fall. Their real risk wasn't market volatility. It was avoidable tax friction that reduced flexibility and long-term optionality. They didn't need a new product. They needed a coordinated structure. Traditional diversification assumes stocks and bonds hedge each other. But correlations shift. Inflation compresses bond protection, and today's public markets are more concentrated than ever. At the same time, a larger share of the opportunity set now sits outside the traditional stock and bond menu. A portfolio built solely on public assets often ends up with concentration risk, limited tax defense, and little coordination between income, gains, and liquidity. This is where architecture matters. Before discussing any strategy, we begin with diagnostic discipline. We look at how income flows, how gains are realized, how liquidity is structured, and how each investment interacts with the family's tax profile. We evaluate manager quality, fee layers, and the actual role each asset plays. The goal isn't complexity, it's alignment, ensuring the structure reflects the family's real tax reality. Only after diagnosis do we consider tools. When appropriate, and only when appropriate, certain parts of the tax code offer incentives that can reposition capital more efficiently. Energy structures. Depending on structure, tax profile, and source of income, some energy-related investments may generate meaningful first-year deductions that help offset certain types of income. Specialized real estate. Through cost segregation and accelerated depreciation, accredited investors may generate significant paper losses that reduce taxable income while the underlying asset continues to appreciate. Again, depending on structure and eligibility. Opportunity zones. For families facing large capital gains from a business or stock sale, opportunity zones may allow taxes to be deferred, and after a 10-year hold, may allow future appreciation to avoid federal capital gains tax. Subject to program rules. These are not universal solutions. They are selective tools used only when the diagnostic process confirms they fit the family's architecture. If you're experiencing rising tax friction, concentrated exposure, or a structure that no longer reflects your reality, the next step isn't a product discussion. It's a private diagnostic review. During this review, we'll map the pressure points in your current architecture and determine whether tools like energy, real estate, or opportunity zones have a legitimate role, or whether a simpler coordination plan solves the problem. Visit altsadvisors.com to request a confidential review. This is about building a structure that preserves family capital with more control, coordination, and tax efficiency. I'm David Harris, and this is Investing Outside the Box.